It is, in fact, related to a specific time period, so that you'd recognize it in the period incurred. And examples, of course, would be most administrative costs like insurance, utilities, marketing costs. We talk about direct response advertising. That's direct response advertising could be, that's an exception, that could be associated with specific revenues. So for instance, they'll say, you're buying something online, right? We just gave you a code to save 50%. That's direct response advertising. You get an email and says, look, you go online right now between now and the end of the day today, use the code and we'll give you 50% off your next order. That's direct response advertising. I could trace the cost of that discount. I could trace the cost of that advertising directly to revenue. But most other marketing costs, not necessarily associated. And of course, research and development. You spend on R&D, there is a very small probability that you can link that to revenue generating ability. Advertising and R&D costs are discretionary in nature in the sense that you don't see an immediate impact on revenue. So you advertise today and you're putting all these ads on television or on the internet. Those ads are running. You can't really gauge the revenue generated immediately from that. The same with your research activities. Those may or may not be developed into a product or a product enhancement for years.
Would an intangible, like patents, fall into this category as
Well, they will be patents, but again, we're talking about expenses. So the patent would be the end product of, and you have to buy research from somebody else to get that, or buy the patent from somebody else, because the patent today is very, very minor in its dollar value because R&D are expense. So if you spend $6 billion to develop some type of new pharmaceutical product, that's all expense. So when you go for the patent, it's just a matter of registration fees and it's nominal.
Okay, so
But if you buy the patent or you buy the research from someone else, clearly it's going to be maybe a substantial item. All right, so you got direct association, immediate recognition, and the third is the allocations. And this is where it gets a little tricky because cost benefit more than one period. It is not, in fact, associated with a specific revenue transaction or a specific time period. And examples would be most deferred costs on a long-term basis. So we know that on a plant asset, you capitalize that account. Capitalize means to add to an asset. So that means that you're going to debit the asset account, and then as it's used up, you're going to depreciate it or amortize it. Now, we'll get back to this terminology a lot later. For those of you that might have studied some finance, you probably saw the term DDA, depreciation, depletion, amortization. It's all the same process. Depletion is related to natural resources. Amortization is related to intangible assets like a patent. So if a patent was on your books, the expense from that patent's loss of value would be called amortization.
okay.
So it would be an expense after it's on your books for a certain period of time. So now, those are the three categories of expenses. For us, in this chapter, we're going to go back and think about direct association, and we're going to think about inventory. So we said that inventories will result in a cost of goods sold immediately when the product is sold. And generally for retail and wholesale type companies, cost of goods sold is an extremely significant item on the company's financial statements. So that we know that sales minus cost of goods sold is gross profit. We'll talk about that a little bit in a bit. But cost of goods sold is generally one of the most significant line items on a retail or a wholesale company's income statement. That represents the cost of inventory sold, and it's matched immediately against that revenue. There's a direct association. And we know that from the way in which we journalize the entries, which I'll review with you in just a moment. On the balance, this is the income statement side. So inventory valuation, let me just make sure this is clear, because we're going to talk about inventory valuation in a minute. And inventory valuation will impact both the income statement through the cost of goods sold, and on the balance sheet, the inventory valuation, or the amount we carry, the inventory balance. Now, if you remember, I know you remember because you just studied this for the exam. So if you remember when we looked at the definition of generally accepted accounting principles, we said that these are broad reporting guidelines representing the best alternative methods. There's always more than one method to account for something. So today on the exam, allowance method, using what? Percentage of sales or aging. Balance sheet versus an income statement focus. This is going to be repetitive. And in fact, I answered someone's email yesterday and said, you know what? I mean, this is a standard kind of issue that keeps coming up. So we're going to find the same issue here. We're going to find that there are different inventory valuation methods. We're going to have a couple of valuation alternatives. And these alternatives will result in a different cost of goods sold and a different inventory on the balance sheet. Same idea. One is going to be an income statement focused method. Another one is going to be a balance sheet focused method. So if your objective is to properly value inventory, you would use one method. If your objective is to properly match the cost of goods sold with the revenues of the period, you'd use a different method. Same thing like percentage of sales versus the allowance approach with the aging. So it's the same fundamental concept, and these fundamental concepts will keep repeating themselves over and over again. So whatever you did today on the exam, whatever you thought about with respect to inventory value, accounts receivable valuation is going to apply here as well. Now on the balance sheet, of course, we know that inventory, of course, is a deferred cost, just like prepaid insurance. You buy it, it's got asset value until it's sold. So we capitalize it, we know that. We also know that when it's sold, we transfer that value to the income statement through the cost of goods sold. And of course, the gross profit is sales minus the cost of goods sold. The service company is going to have cost of services provided. So the gross margin or the gross profit, by the way, terminology, you have to be a little careful here because gross profit is usually an absolute dollar amount. The gross margin is usually in percentage terms. Although sometimes the terms are used synonymously. So if I ask you on the exam, final exam, I want the gross margin, you have to be clear as to whether or not I'm looking for the percentage or the dollar amount. Usually the gross margin is gross profit divided by sales. So you have to watch the terminology, but hopefully we'll be as clear as possible. So the balance sheet, again, is going to be affected as well. And again, it's a significant item on the balance sheet. All right, so now let's go back just for a minute and review accounting for acquiring and selling inventory. And once again, we'll look at our accounting equation and journal entry. So we have a company that buys 60 pair of swim goggles and the resale, and their cost is 60. So they spent 240. So their total cost of inventory in this case, when they go out and buy it, they decide right now that they have 60 units at the $4, or the 240 is what they acquired. Now that 240 sits on the balance sheet now until it's sold. So that becomes inventory, it's an asset. Until you sell that asset, it still has economic value. During the exam today, someone asked a question about the supplies. Same idea, those supplies are sitting on your balance sheet as an asset until they're used up. Inventory is really just a special case of a supply, if you like. Same basic idea. All right, so when you buy it, you're going to increase the asset inventory and reduce the asset cash. Again, just to remind you, we did a lot of this during the review yesterday. No effect. I mean, it does not have to affect. If cash goes out the door, it doesn't necessarily mean it's going to affect your wealth. It's not going to affect your earned capital, your retained earnings, or your equity. So the example I gave you yesterday, if you went out and bought a ream of copy paper, you took $20 to do that, that paper is an asset to you because it has future benefit. So your wealth has not changed. So the notion that cash out the door means an expense has to be corrected as soon as you can. Because just because there's a cash outflow does not necessarily mean that your wealth decreased. You're just substituting one asset for another. So you basically just took a generally non-productive asset. You know, if you're an investment house, cash can help you a lot, or a financial service company. But for retailers, as we're seeing here, you're taking a generally non-productive asset, cash, and converting it into a productive asset. It does not change your wealth. It does not change your wealth at all. It does not change stockholders. And stockholders' equity is wealth. And it's not an expense until what? It's used up. So the journal entry you would make is debit the inventory and credit cash. Even if you bought the inventory on credit and credit accounts payable, it's not really an issue. Then when you sell the inventory, we generally make two entries. So we're going to sell the inventory, we're selling 50 of them for $10. So we're going to have total revenue in this case of $500 and cost of goods sold of $2. So let's see how that would work. So out of this total amount, so you had $240 in total, and your selling price that's the cost of inventory purchased. That's going to be $240. Now, when you first look at this chapter, what you have to make sure you do is differentiate clearly between the cost and the selling price. So selling price is $500, so you would debit cash and you would credit sales revenue. You notice also that the sales revenue is going to increase your net income and, of course, increase retained earnings. What's my cost of goods sold on this? Cost of goods sold is 50 units at a cost of 4, so it's 200. So it's 200 cost of goods sold. Gross profit is 300. Gross profit's 300. So when you look at the income statement, cost of goods sold is an expense that reduces income and reduces retained earnings. And those are the journal entries. Anytime you have a sale, because of this direct association, you've got to make two entries. You're going to debit cash, credit sales, debit cost of goods sold, credit inventory. Notice that inventory now is a balance of 40, and that means out of the total amount you purchased 240, 200 of it sold, and 40 is left. Just like the supplies, the same idea in today's exam. I think it was like 3,200, and you used up 2,200, there was 1,000 left. Same idea. So you've got 240 acquired, you sold 200, and you have 40 left. The balance is 40. So the cost of goods sold, in this case, is 200, the sales revenue is 5, and your total wealth increased by the amount of the gross profit of 300. So to review, this is the way you would record inventory purchase. If you have an inventory credit cash or accounts payable, anytime you have a sale, you're going to reduce the inventory and record the cost of goods sold for each sale. By the way, this sale could have been, don't forget, revenues or what? Asset inflows. This could have been a receivable. Doesn't have to be cash. All right, so before we move ahead, any questions on the inventory transactions? Because we want to be sure that you're comfortable with acquisitions and sales. All right, yeah, I'm going to get back to this later, but depending on what inventory methods you use, you may wind up with a different cost of goods sold. You may wind up with a different gross profit. You may wind up with a different ending inventory balance, and we'll get to that in just a few minutes. But now, when you look at the acquisition of inventory, in this case it was pretty straightforward. They paid $4 a unit. But inventory cost is really a little bit more complicated than that. So when we think about the actual cost of inventory, and this is going to be true for any asset, it's going to be equal to the invoice price or, if you manufacture it yourself, so whatever you pay a supplier or whatever it costs you to manufacture that product, plus what we're going to consider to be reasonable and necessary expenditures. Now, these reasonable and necessary expenditures are required to have the inventory in place or in its location and have them ready for sale. So the total cost of inventory is really made up of the sum of the invoice price or manufacturing cost plus whatever is considered to be reasonable and necessary to have the inventory in its current location and ready for sale. That's basically its intended use. Now, whatever costs go in there is going to depend on what I would call the company's capitalization policy. All companies have different policies. To show you what I mean by capitalization policy, and I'll put that term on the board in a second, but to show you what I mean is that, of course, the cost to acquire is the invoice price plus, or I should say, the invoice price plus the cost of manufacturing. Now, here are the other reasonable and necessary expenditures. Do you add transportation into the inventory cost? You probably should, but it depends on the company's policy. What about packaging? If you have to repackage the goods, so you get a shipment, a container comes in Port Newark, Your trucks pick it up, you bring it back to your warehouse, you unload it, maybe you repackage it. Does that go into the cost of inventory? If it doesn't go into the cost of inventory, what do you do with it? Cash outflow. Credit cash. What's the debit? If you don't debit inventory, what are you going to debit? What's your only other choice? Right. You expense them. So the issue, and that's the answer was correct. It's extremely important to understand that choices, if you're given a choice of policy to say my company expenses transportation, what's going to happen? I'm going to have lower inventory and more expense than your company. And it depends on the company's policy. And I'll show you, we're going to see that throughout this entire curriculum. And as I said, if, I mentioned this, if you asked me to teach accounting in 5 minutes, that would be the topic I would talk about, expensing versus capitalizing. When you have a cash outflow or you're committed to pay for an event, how do you handle that? Do you call it an asset? Do you call it an expense? And sometimes it's questionable. For example, packaging. If you have to repackage the items, is it an expense or is it inventory? I'll give you a perfect example. What would you do in a case of auto dealerships? Right? Everyone's got an auto dealership in their neighborhood, right? And I don't know if you noticed, but sometimes they got cars parked all over the place, right? One time I drove by a bar and I see, 30 or 40 Chevys in there, and I said, gee, everyone drives a Chevy at this bar. I don't know why, but then I realized there were no plates on them, and in fact, the dealer just was using the bar's parking lot. They rented it out for excess inventory. So that may not work. Maybe the bar wants their parking lot back. What do they have to do? They have to take all those cars and move them someplace else. Is that efficient? No. Do you expense that or do you capitalize it? What would you think? Is that an expense or is that an asset? Was that reasonable and necessary? It's debatable, but I would say you probably got to do what? Expense them. I would expense them because it's inefficiency. Right? Inability to store those items means you have to move them from one location to another, and that may be inefficient. So I'm just kind of broadening your thinking. You're not going to be faced with situations that are very narrow. There's going to be a choice somewhere. So, transportation, packaging. One of my clients used to receive goods at a port, whether it was Port Newark or New York, get the goods, put them in trucks and vans, and redistribute them all over the United States. Some of the years that I worked for this client, they would treat them as inventory costs. Other years, they changed their approach, they expense them. So these types of events occur quite often. Another item that could go in there are incentives. So you could have a volume discount. A volume discount is where you get a discount if you buy more than 5, more than 10. That actually determines the invoice price. We're going to see this a little bit more next semester. Cash discounts, sometimes called sales discounts. In this case, it would be a purchase discount. And in the terms or written on the invoice, that means that you would get a 2% discount if you pay it within 10 days. We'll give you 2% off. If not, net 30 means you pay the full amount within the 30 days. So, for example, if you bought inventory for 100, let's say the terms were 210, net 30. If you pay that within the discount period, what would happen? you can get rid of a $100 liability for how much money? How much would you have to give them if you paid them within the discount period? 98. And the inventory cost would be reduced. So that's if paid within the discount period. So if you paid it within the discount period, you could pay off the entire liability for 98. What would happen if you paid it past the discount period? How much would you have to pay them? 100. So you just have accounts payable and cash. But you notice that the discount is going to reduce the cost of inventory. The discount would reduce the cost of inventory. By the way, you don't have to account for volume discounts. Why not? Now, they're already in the invoice, right? You know, that's negotiated before the invoice is printed. That's negotiated before your credit card is charged or before you pay the bill. It's before the items are even shipped. The volume discount is taken. All right, so that's one possible way to get the inventory reduced. And by the way, why do you do that? From a business perspective, why do you offer someone, the volume discount obviously to get them to buy more, but why do you offer 2% discount if you pay early?
It's an incentive to get the money as fast as possible.
Yeah, it improves your cash flow. And what you have to do, like any other business decision, if you're selling and you offer someone a 2% discount, it improves cash flow on both sides in the sense that the buyer pays less, but the seller gets it quicker. And the faster you get your money, the more you could do with it, and obviously you're going to be getting more than 2% return on that money. That's the whole point. And it's the same thing, on a credit card sale. Credit cards are going to charge you a few percentage points. You're not going to get the full amount, but you get it right away. It's cash. It's as good as cash. All right. Any other questions here on the inventory, what goes into inventory costs? All right, now, the other problem, all these shipping, we talked about, reasonable and necessary, including transportation. Question is, who pays for the shipping? And that's going to depend on the shipping terms. And that'll also determine legal title. There are two ways, and by the way, you have to be careful as an auditor. You have to know what the shipping terms are. The FOB means free on board. FOB shipping point means that as soon as the items are handed over to the common carrier. So for example, you're buying something from me. Out in my loading dock, FedEx truck pulls up. They pick up the items. At that point, if it's FOB shipping point, I'm off the hook. I sold the goods. It's now your inventory. You have legal title, and you pay the freight. So FOB shipping point means the buyer gets title and is responsible for the freight as soon as the goods are handed over to the common carrier. So again, FOB shipping point, the buyer pays the freight. The buyer has legal title as soon as the goods are handed over to the common carrier. Destination, this is where it's free shipping for the buyer. The goods are still in my inventory, so if I'm the seller and I ship to you FOB destination, first, I still have title to those goods while they're in transit. Second, I'm responsible for the freight. So the seller pays the freight. The seller keeps title until the goods reach the destination. Now that's important because and I remember doing this, and I think they still do it, or probably do it a little bit more automated these days. You have to check shipping documents, because if an item is shipped the day before you're taking the physical inventory, if an item shipped the day before you're taking the inventory, is that good, or all those goods in your client's inventory or not? What does it depend on? The shipping terms. If all of those items were shipped FOB shipping point, they're not in your inventory. If it's FOB destination, I got to put them back into your inventory. Even though I don't count them physically, they're on a truck going somewhere, I can't count them, but yet based on the shipping documents, the bill of lading, whatever I'm looking at, I could determine how much of that inventory is still in my client's inventory. So the shipping terms will determine not only who pays the freight, but also legal title. And I know we also, talked about the problems. We already mentioned this, consignment. Goods on consignment is the same thing, where goods are sitting in somebody else's warehouse, but you still own them. You still own them. All right, now, so far we were really looking at, and by the way, goods in transit, that's related to FOB destination. Now, so far we've been looking at a retail company or a wholesale. Just want to make sure, we're not going to go into detail on this, but just to make sure that you are somewhat familiar, there's a whole course in management of cost accounting. If you manufacture products yourself, you carry 3 types of inventory. There's the raw materials or direct materials. These are the input into the production process. Work in process inventory is partially completed inventory. That includes direct materials or the raw materials. It includes labor and overhead. And what's overhead? Overhead would be utilities, cost of security, property taxes on the factory would have to go into the product. Right, so if you manufacture your own product, it has raw materials, direct labor cost, and also overhead. Now the overhead is really the support charges for utilities, supervisory salaries, people that don't work on the manufacturing directly, but those costs have to be incurred. And then finally, the finished goods inventory. These are the inventory items that are ready for sale. Actually, this is the equivalent to the merchandise inventory you see on a retail company's books. So finished goods inventory is the same as merchandise inventory. So if you look at Walmart's financial statements and they say inventory or merchandise inventory, that's the same as finished goods. So the finished goods are the goods that are ready for sale. Now, on a published financial statement, you'll either see these on the face of the balance sheet or you'll see them in the footnotes to the financial statements. But you notice you've got the inventory for Cisco systems, you've got raw materials, 77 million, 5 million in work in process, and then of course the finished goods. There are 2 categories there. You've got manufactured finished goods that are still in the warehouse. 595 represents almost like consignments. What Cisco does is to send inventory over to distributors. They hold them until the demand is there for the product. So it's like a consignment. All right, so that's our overview of inventory. Anyone with any questions? We're going to do a couple of questions now. I'll answer a lot of them myself, but or with you. Any other questions or any questions at all regarding the basics of just the overview of inventory? We still haven't valued inventory yet. This again is the key issue for this chapter is inventory valuation.